Welcome back to the What's More podcast. I'm your host, Quinton Harris, and you are dialed in for a special episode today. I've got two experts with me from My Exemption Check. It's a father-son dynamic duo. We've got Casey and Steve Vockel here with us today. I'm real excited about this episode because if you're listening and you don't live in the state of Florida, but hey, maybe you might buy a property here one day, hang in there with us because what you're going to find out is what I like to call a property hack. And it's a hack because it's something that a lot of people are unaware of, including myself, until really I got a chance to sit down with these two gentlemen today. You know, Casey is a veteran and a firefighter. Thank you for your service. Joining us on the show today. But he kind of came up with this concept with My Exemption Check, along with his father, Steve, who is an expert appraiser. Been doing this for 35 years in the state of Florida. And as you're going to find this episode, there's so much experts. They've been called to courtrooms to testify as expert witnesses in the category we're going to talk about today. And when you hear My Exemption Check, I'm not talking like a physical check in your hand, but checking on your properties. And that's what we're going to talk about today, because as a homeowner, a lot of people know what their property taxes are and they know they got to pay them. But what they don't know is the money they can save. And if you're listening to this episode today, you're going to save money just listening to what these gentlemen have to say. I'm very excited to have them on the show. And you know, I wouldn't bring just any guest on the show. I'm not going to bring someone who's going to waste your time. And these two guys are going to make you money today. So thanks for joining us on the show, and welcome to What's More podcast.
Well, thank you for having us.
Yeah, I'm excited here. So let's get right into it. Let's back up and talk about how this premise of what we're going to talk about, Portability Day, came about. And I think it started back in 1996. Steve, you were telling me earlier about the Save Our Homes Act. That's where this Homestead exemption started to begin with. Is that correct?
It did. The Save Our Homes Act was in 1996, and that was to give people homestead exemption, which we'll talk about in a minute. Mm-hmm. And then 2008, they did an amendment to the Save Our Homes Act in Florida, which allowed for portability, which, of course, we'll get into a little bit more. So.
Yeah, so if you live in the state of Florida, you know you have a homestead exemption, right? And a homestead exemption is, you know, if you're not in the state of Florida, some people say, oh yeah, I got a homestead. And you think about like, that's a way to protect your property, right? Against lawsuits and all kinds of things. In Florida, it does that, but the homestead is an amount you get off your tax bill that actually determines your tax rate. And then the portability is what we're going to do the bulk of the show on. That's a lot of things that just people leave and forget about on the table here. So Casey, give me your definition. Like, what homestead? Like, how could I explain that to someone that doesn't own a home yet?
Yeah, absolutely.
And maybe even just easy for someone that does own a home, but maybe not know what it is. They just know they get it.
Sure. So like you mentioned, the homestead exemption itself is for your primary residence, and it's a $50,000 deduction off of your taxable value. Mm-hmm. What a lot of people don't realize is it also caps the amount that your taxes can go up every year, or the taxable value rather, to 3%, or the consumer price index, whatever is greater. So the
So if you're a homeowner, if you're a homeowner, you know your property taxes can only go up a certain amount, which is typically 3%
yes.
of the current tax rate each year. It can only go up a max of that. Maybe not necessarily, but most cases it goes up to 3%,
Correct.
right?
It's whichever is less. Right? I think I said greater.
Yeah, and that's for your primary residence, right?
Yes.
Yeah. So if you own a rental property or a second home, you may be not capable of taking advantage of this, is what I'm trying to say.
Yeah, so if it's not your primary residence, there's a 10% cap. It's the non-homesteaded cap. So as long as there's no transfer of ownership, it is capped at a 10% annual increase for the assessed value, which is where your taxes come off of.
Okay. So, and as we get into a homestead, and then there's a super homestead that came about, where that number used to be 25,000, then it jumped to 50,000. That's correct? What's where we're at right now?
Yeah, so it's kind of confusing how it's worded, but the simplified version is there's a $25,000 exemption that covers all of the taxable value of the mm-hmm. property, and that's up to a certain value. And then there's an additional $25,000 exemption that covers everything except for school taxes. Okay. Combined, it's a $50,000 exemption except for the school portion of your tax rate, but generally speaking, it's a $50,000 exemption off of your property taxes.
So I got to ask, like, you're sitting around, like, how did you come up with this idea of My Exemption Check? Like, most people don't just sit around and go, oh man, I wonder if I can get my tax bill lower. Like, how would I go about investigating that? What brought this to the forefront here?
So, you know, when I bought a house, I hadn't been involved in real estate at all. I wasn't working with my father, Steve, on the appraisal side, and there's a lot going on, and I never filed for Homestead. And, you know, a year or two later, I was one of those, and there's a lot of those out there. And I don't even know how it got brought up, but someone mentioned that the exemption wasn't on there, and I went and filed. And the 2 years of not having it not only cost me the $50,000 exemption every year, but it also cost me, instead of having a 3% cap on my taxable value, it was a 10% cap. So I lost, a decent amount of money. I try not to calculate what it was, but it was decent. And at first I thought that was just my mistake. And then through kind of research and talking with homeowners, a lot of people aren't doing this. There's realtors out there that haven't done it. Usually the biggest issue we run into is it was the husband's job to do it, and he never did it.
Yeah.
So there's a lot that people don't realize to that. And then as we'll get into in a little bit, there's portability as well, which is an additional benefit to that. And it's just there's a big disconnect between the property appraiser's office and the taxpayer themselves. And we just wanted to create something to bridge that gap and kind of educate people along the way.
Yeah, and the one thing about this is the state and the city and the county, they're not going to call you and go, hey, Casey, you haven't filed your homestead yet. Like,
absolutely.
Yeah, it's more money for them, right? They're not going to call you and be like, and they're absolutely not going to refund you where you didn't file. They're not going to retro this thing for you. So, the first takeaway here, homeowners, new homeowners, future homeowners, hey, if you just bought or you're looking to buy, file your homestead immediately so you can take advantage of that. That's check number one. Now, have you dialed it in? Like, what is the $50,000 like monetarily? What do you think that kind of represents in the form of like what, $300 a year, $500? Like, what do you think? Rough numbers.
So every county's got its own millage rate. Right. So if you know the millage rate, you would simply multiply that by 50,000. I think we use a 1.5% or 15 mils is our estimate. And I'm not good at math.
1.5% is going to be roughly around, what is that? 50,000. You got 500 half. So you're going to be 750.
I think it's 750.
Quick math. I'm sure you'll check me online for this one. Tell me I'm right or wrong. That was it.
750. Now, if you're in an area with a higher tax rate, it's going to be worth more. If you're in an area with a lower tax rate, it's going to be worth less. But, it's the 50,000 is one thing, but it's protecting yourself from the appreciation. That's really a big deal. And not having that homestead on there is just going to kill you in taxes.
Yeah. So when you look at a tax bill, Steve, for our audience, you're not taxed. Like people go, oh man, my home's worth $500,000. You're not taxed on what your value of your home is. You're taxed on the tax assessed value. We kind of explain the two, as you're in your expertise, explain the two different models there.
Well, your assessment's based on about 85% of the sales price when you buy the house.
So if I bought a home for, let's say, $400,000, it's going to be roughly, I don't know, what, a 360, something like that?
Something like that. And that will be your new assessed value. If you then go ahead and homestead that property, it's going to be capped at a 3%. 3.5%.
It's 3%.
3% per year.
Yeah.
Okay.
Or the CPI, whichever's less. So that's how they determine the original assessed value. And then, of course, it goes up incrementally based on that cap.
Yeah. I've never heard that it was attached to the CPI. Like, I never knew that, and I've been doing this for 22 years, had no idea, so that's good to know. So, hey, another reason to cheer on that low inflation there, right? So that we can actually use that as a lower millage rate, as an appreciation rate. So that's what you're taxed on. And so let's kind of back up for our audience here because, one of the things we always talk about is the difference between 2008 and now. Because, there's always these doom and gloomers out there that want to say this is another 2008. And that's a whole other podcast, right? But in 2008, when they came up with this amendment to the Save Our Homes Act, there was a differential in what homes were worth because property values had started to drop in 08, 9, and 10, and then what their tax value was. And people were necessarily overtaxed based on what that home was valued at. Because if you bought a home for, again, $500,000 and it became upside down and now it's worth $350,000, but you're being taxed at $380,000, that was a problem.
Sure, and as an appraiser, we got quite a few tax appeals at the time saying, hey, I think I'm overassessed, and they were, and we'd have to go to the county and say, listen, in your example, it's been overassessed. We need to drop it down to at least the market value.
Yeah, and you were very successful with that.
Yes.
Getting that done.
Yes,
yeah.
correct.
And so, that's kind of what 2008 looked like. Now, moving forward, we have the complete opposite problem after COVID. Our market was already hot to begin with, but boy, did it explode during COVID and post-COVID. We continue to see high appreciation rates that maybe other parts of the country aren't necessarily getting. So it's the complete opposite. We've got homes that are rising in rapid rates of value that the assessors are not necessarily giving credit to because, again, the difference between your tax rate and then what the home value is on that tax card. Well, that's what we're getting ready to talk about, right?
Yeah, I'm happy to dive into that now if you'd like. So there's kind of three numbers that you want to look at on your tax card. There's a lot more on there, but the main ones are your market value. That's what the county says your home is worth, minus the cost of sale adjustment. The assessed value, that's the number your taxes are based off of. And then there is your taxable value, which is your assessed value minus any exemptions. So the $50,000 homestead exemption would be in that category. What we've come to find is that sometimes the market value that the county has on your property is not accurate to what your home is truly worth. Steve, you want to kind of dive into that on the appraisal side?
Yeah, so just to put in perspective what he's talking about, the county comes out, and I'm generalizing here, the county comes out and says, we assess your home at $200,000. And they put a $200,000 assessed value on there. And they say, based on our research, your market value is $400,000. That $200,000 difference between the assessed value and the market value is your savings. And that savings you can port or take with you from one homesteaded property to your next homesteaded property. And that $200,000 in our example is like a discount coupon off of your new assessed value.
I see.
But what a lot of people don't know is that if you've got a house in our example that's assessed for $200,000, the county assessor says it's worth $400,000, you may be selling it for $650,000. Well, $650,000 would be a more accurate representation of the actual market value than what the county came up with. And you are entitled to the actual market value of that. So one of the things that we do is we go in there and argue with the county and say, listen, you've got their market value at $400,000. Here's proof that it's worth $650,000. Let's go ahead and appeal it. You need to give them the full value. So once that happens, now they're taking the difference between the $200,000 assessment. Instead of $400,000 market value, it's $650,000. So we just increased what you can port over from $200,000 to $450,000.
Yeah, and right now the money machine sound should be going off right now in your head, because that's a huge savings.
It's a huge savings, and they do mass appraisals, which is accurate, probably 96% accurate. But it's those outliers. We've got riverfront, oceanfront, marshfront, lakefront. Every kind of front. We've got historic and things that a computer program is not going to pick up. So when we see those discrepancies, we say, hey, we need to go ahead and appeal this with the county. So what we do is, I've been an appraiser for 35 years. We're going to give them a compliant appraisal that says, listen, based on our research, in our example, it's worth $650,000. We've got a contract on it for $650,000. And by the time you go to the VAB, which is Valuation Adjustment Board, if needed, we're going to have an actual sale for $650,000. It's going to be hard for the county to argue, well, it's only worth $400,000.
Right.
So it's really not a difficult argument, and we're working within the constraints and everything of their processes. But so far, we've been extremely successful in getting those changed.
And would it be fair to say that when the county does that mass appraisal, like the way I always thought about it is they would drive around, let's say, one street, and basically that street is going to get a value of A, B, C, D, but it's predetermined. Like it wasn't, they're not going out and seeing the property, what I'm trying to say. They're not physically
they
going
don't go out and see the property.
Right.
And it's based on algorithms that I haven't seen, but we can argue about how exactly they do it, but it's the general value of that subdivision and all properties that are alike. But like you say, you may have a subdivision where you've got a mobile home on half an acre right next to $1 million home on an acre. So obviously those numbers are going to get skewed to some degree.
Right.
And if they don't keep up with the appreciation, like we talked about in Northeast Florida, has been crazy the last 4 or 5 years. It's slowed down a bit. Then that number, that spread between what they have as the market value and what the actual market value is money left on the table.
Right.
And that's where we come in. We evaluate it and say, hey, listen, there's quite a bit of spread here. Let's go ahead and get this appealed so you get the maximum value that you are entitled to legally to port to your next house or bring to your next house.
Yeah, and if you're a homeowner, this is where you really want to dial in and listen, because if you're thinking, sellers are buyers, right? You sell a home, you buy another home, typically speaking. So if you're thinking about selling, and I'm going to defer to you here in a moment, Casey, or you've sold in the last maybe 3 years, listen to what they're saying right here, because you can transfer that portability. You may not be able to take advantage of getting that new appraisal. You might be able to. You'll speak to that here in a minute. But you can transfer the portability if you haven't done it yet. So do you want to talk a little bit about that? If you're thinking about selling, or you've sold in the last 3 years,
there's some time constraints that he's going to go over.
Okay. Yeah. So like we said, if you buy a home, you homestead it right away because you remembered. No matter what appreciation does to the house, your assessed value, which is your taxable value, can only go up 3%. So if you have a house that's now worth $1 million, but you're paying taxes on $500,000, and you buy another home for around $1 million, you're able to actually capture that benefit from your cap on your one home and bring it to your new home in Florida. So your tax bill would remain somewhat constant, even though you're buying a house that's worth twice as what the one you're paying taxes on was assessed for. And it was to keep Florida homeowners, it's encourage moving, but to keep them in the state. So, the perfect example is the guy I bought my house from. He bought it, or he actually built it in the 80s. And he lived there with his wife up until I bought it in 2019. And he moved right down the street, and all he wanted was a single-story house. That's the only reason he moved. Mm-hmm. And he would have been taxed out of our neighborhood if it wasn't for portability. But because he was able to bring with him that savings he's captured since the 80s with him, his tax bill remained constant. Now, I know that portability didn't come into play until 2008, but it was still a significant amount of savings he got to bring with him. So his taxes remain constant from one house to the next.
Yeah, that's huge. You know, we talk about affordability right now, and taxes and homeowners insurance are really cramping a lot of that. I mean, we know rates are playing a large role, but taxes and insurance are these kind of missing variables that should be fixed costs that now are escalating. And, you know, Florida insurance has been quite the pill here recently, but now taxes are, you know, they're also going up in a lot of retrospects, because what we have is we have these new homeowners that are coming to the board that want to buy right now. But the properties that are being listed, not all of them were once homesteaded, and some of them are Airbnbs that are being sold or investments. So, you know, what could someone who's maybe looking at a property that is like an Airbnb style property, they're looking to buy it, the homeowner wants to sell it, or that's, you know, second or investment property, what can they do to say, hey, listen, I see the taxes now are $10,000 on this, but what can they do to get that flipped around to where it's maybe $5,000 or even less? Like, what should they be looking at?
So when you buy a house, whether it be for an investment property or your primary residence, it's not usually a good idea to base your taxes on whatever the current owner's paying, because whether the home you're buying is a homestead or not, they're going to have some form of a cap on there if they've been there for any amount of time. Once there's a transfer of ownership, it is going to be reassessed the following year based on what it is truly worth. So if you're buying a home for an investment purpose, you'll have a 10% cap on that property. So to be safe, you want to take 85% of your purchase price, and that's going to be your taxable value year one. And whether you homestead it or not determines whether it has a 3% or a 10% appreciation rate. Now, you know, we don't know if the full 10% would be realized depending on what inflation ends up actually being, because they do take whatever is less. But a good rule of thumb would be just going off of the purchase price and kind of going from that.
Okay. No, that makes sense. So as a homeowner, right? So you're saying, I'm looking to buy a property. I see the tax bill. You're saying step one, don't look at that tax bill. Don't base anything on that, because obviously it could be a false narrative, right?
Correct.
Could be higher. In most cases, it will be, especially with the appreciation rate that we're experiencing here. So the second thing is file your homestead. And then the third thing is, if you're looking to sell, let's talk portability.
Correct.
So the average person will never figure this out. I mean, this has been around since 2008, and I'm only starting to hear about it over the last 2 years, which tells me a lot of people haven't figured this out, including the professionals, right?
Sure.
And so you guys have come to the table and you have found a way to streamline this process. And, you know, what I want to kind of talk about right now, and we're going to put all their information on our YouTube channel at What's Your One More. If you will, go subscribe. We're going to have a link right to the show, or excuse me, from the show, of how to get in touch with these two gentlemen here. But let's talk about it. I'm a customer. I come to you. I pulled up a tax card here.
Okay.
So you know, so you hear me typing in the background. I should have told you that. They were probably thinking, like, dude, what in the hell is this guy typing? So I pulled up a tax card. And so, you know, 2024s are in progress right now.
Correct.
Right? You know this better than me. So this particular tax card, right, it has a market value of $733,000. Okay. And rounded up numbers, the assessed value is $510,000. So for all purposes, for our audience, that's $223,000 of portability.
Correct.
That this homeowner could take and put down towards the purchase of, let's say they were going to go buy a home that's $900,000. Correct. So now, how
in Florida?
In Florida, specific. Thank you for reminding me. In Florida, what does that 223 do? So now you take 85% of 900,000. Let's just use $1 million, right? Because it's easy numbers.
Sure.
So it'd be 850,000 minus 233 minus 50. Is that right? Is that how that would work now?
That's correct. So you're, you know, if
that's powerful.
Yeah, absolutely. So, you know, like I said, there's a cost of sale adjustment. Sure. So let's say you buy a house for $1 million. In a perfect world, the market value on that home for the first year you own it is $850, because that's 85% of your purchase price. Your portability then comes off of that number, and that makes your assessed value. And then from your assessed value, you deduct the $50,000 exemption and any other exemptions you may have, because there are quite a bit in Florida, less common, but they are there. And that would be your new taxable value. So buying a house for $1 million with no homestead and no portability, you're paying taxes on $850. Let's say you had $250,000 in portability. Now you're paying taxes on
roughly
$600,000 minus $50,000.
So $550.
So now you're paying on $550. That's a significant difference.
Now,
you know?
and this hasn't even been challenged. Like this hasn't even been altered. This is what they're thinking about. This, if you're honest, they're just giving you this. So you know there's got to be more to it, because the state's just not going to overgive you something on this one, right? The city.
Exactly.
So you know, I would imagine if I just did like a quick search AVM on this property is worth at least $900,000. So there's another 170 in this example with your expertise, Steve, that you could challenge and they turn that 230 into 400
potentially. And again, you know, we have to take off 15% from the 900. So if this house, let's say just for easy numbers, was $1 million home as of January 1st, because we are required to look at the January 1st value. the market value should be 850. So 850 is the accurate number versus what number is there. So that difference is portability you're essentially leaving behind.
Okay.
And if you don't correct that before you close on the house, or at least begin the process with us before you close on the house, there's nothing you can do. So if I sold that, if I was the homeowner of this home and I sold that, I would only get that 230. I couldn't go back and get additional value. Correct. So if you came to me with that property now and you said, I sold last month, what's my portability? I think it should be higher. If we were to appeal that value, the answer you would get is, you're not the taxpayer anymore. Somebody else owns the house. You cannot appeal. Okay. So if you came to me before you sold the house and you said, I'm preparing to sell the house, what we do is we work with the title company, we work with the realtors, and then ultimately the buyer. And we would get a buyer authorization form that allows us, on behalf of the buyer, to continue an appeal for the tax year 2024, which would then allow me to continue after the sale of the house to increase the value for 2024 and then maximize your portability. And every tax roll's on its own. And since you're buying the house for $1 million, it's going to be reassessed at that $1 million mark next year anyway. So us arguing the values for 24 does not have an impact on the buyer, but it does have an impact on the seller if they don't get it corrected.
See, I heard two things there that are really important takeaways for me. Was number one, you can do it at the point of when you're getting ready to sell, when you're meeting with the agent and the title company, which tells me the second thing, this is a pretty fast process you guys get done. This doesn't drag out. You see results rather quickly. So
we do our end first to maintain standing, because ultimately it comes down to standing. So there's a few different
legal standing.
Legal standing. Yeah. Gotcha. So it's almost like it's a pending process, like you're
correct. Yeah, just to kind of clarify what he says, if you're selling the house and you go to appeal it and you don't get to the appeal till 3 months later, they're going to look at you and say, well, you're no longer the homeowner. You have no standing in this. So with the document we get signed, they look at it and says, you're just appealing, continuing a process where you did have standing with the authorization of the new owner to continue what has already been started.
Gotcha.
So that remains standing so we can advocate on their behalf.
And does that standing have to wait until the January? Is that the date you have to wait till, or you can do it?
So it's the year of which you appeal. Gotcha. So, any time in 2024 that we're appealing, whether you close and move on January 2nd or you close today, we need to maintain standing throughout the process. And the process can sometimes be quick, and it can be handled at the informal level through the property appraiser's office, or it needs to be escalated to what's called the valuation adjustment board. And that's kind of a step above the property appraiser, and they don't even begin scheduling until September. Okay. So, we maintain that standing throughout. So when September comes around, even though the sale has occurred, which we don't delay the sale in any way, shape, or form, we're able to then, appeal the values for the tax year of which you sold.
And is that delay a problem? No, because it doesn't take effect until the following year anyway. So the fact that, we may have a sale, we're looking at, in your example, it may be in February, and we say we'll start the process. We do the informal hearing. We don't get the results that we think we need. We go to the VAB, which may not be till September, October. You're not missing out on anything because that doesn't become effective until January 1st of the following year anyway. So that delay doesn't hurt anything. But the big thing is to let us know before you close, because once you close on that, we have no options, or have very few options. Yeah, you're far better to, as soon as you know that you're selling and as soon as you know there's an issue, and we've tried to coach realtors and say, listen, just look at the tax card. And in my example, it's $200,000 assessed value, $400,000 market value, and you're getting ready to list their property for them at $650. That should be a bell going off saying there is an issue. There's $250,000 possibly left on the table. Give us a call and we'll handle it, start to finish.
And, one of the things I loved when I first met you guys was that the amount that you guys charge people, it's consistent, but it's so inexpensive for what you're going to save in this system here. And I love something you said. You're like, listen, if we can't even save you on a yearly basis what we're going to charge you, we won't even do it.
Correct. And, we used to try to do it like 1% of your total savings. That was too hard to figure. It was too long to wait. You don't want an open-ended invoice waiting for you. So, we did it based on, we wouldn't do anything unless it saved you more than what we're going to bill you the first year. And guys, remember, this is every year. So the savings that we get you, the additional savings we get you, is there. It's locked in year after year after year. So if we save you an extra $3,800 a year, that's $3,800 a year every year going forward. Extra savings
in your pocket.
In your pocket.
Yeah, that's great. That is wonderful, guys. Again, go to our show notes, go to our YouTube channel, What's Your One More. All their information is going to be in there, as well as a link to their website, how to sign up for this and learn about this. But let's kind of break this down real quick for sellers and buyers. Sure. If you're going to buy a home, file homestead exemption. That's step number one, just to get that done. And let's say if you're going to sell, get with your realtor and get with you guys before you sell and start the process.
Absolutely.
Because here's what I'm hearing, and I feel like I'm pretty knowledgeable of this. I wouldn't want to do what you guys are doing on my own behalf. Number one. And number two, I don't think I could do with the knowledge base that you guys have. And, so get with you guys and get with your real estate agent. Go to this link and sign up and get them started on the process so that you can start hearing that ka-ching in the background as this happens here. Because I've heard it about 6 times on this short episode that we're doing right now. And it just keeps going off my head like this is easy, easy, easy. Now, let me guess. Are there certain counties, and we don't drop names here.
Right.
Are certain counties more flexible than others when it comes to this?
Some can be, and then there's certain people within each county that are a little more flexible. Some people have been doing it a while and want to stick to their guns on things, and some people are relatively new and kind of see the logic in some of the things. We bring them, and what we tell realtors is don't be afraid to call us, because if you call us with 19, cases, if you want to call it that, and all 19 of them we don't recommend an appeal, on the 20th one that we do recommend an appeal, it's worth it to us. So I'd rather you call me with a quick, hey, what do you think?
Yeah, got a question.
And then we'll go from there. We're here to help.
And we can assess that in literally 30 seconds. So if you're a realtor and say, hey, can you look up a property? We do it right there. And it's 30 seconds later, we say, what are you selling it for? And they say, we're around 600. And we look at the assessment, we look at the market value and say, you know what? There's a little bit of a differential, but not enough to fight over, and certainly not enough to warrant our fee. You're good to go. And there's even some comfort in that.
Have you guys ever lost an appeal?
No. We have ongoing appeals, but we've never
think
lost.
About that. Think about that. Yeah, haven't lost, and been doing this for how many years?
We're going into 2.
Yeah, 2 years, haven't lost. That's pretty strong numbers. And, again, for our audience, that's why I said I don't just bring just anyone on the show here, because, we had a credit expert on the show, talked about how people could do stuff for their credit. They had a 100% rate. You guys have a current 100% rate. Congratulations, by the way.
Thank you.
And think about what we're actually doing. You're entitled to market value, and that market value has really been determined before we get there, because you've got a willing buyer and a willing seller with an adequate amount of exposure time on the market. It's an arm's length transaction, to use some buzzwords from real estate. So by the time we get there, in my example, it's going to be listed for $650. The realtor's done their due diligence. A buyer wants to buy it for $650. The seller wants to sell it for $650. I'm giving an appraisal that shows why that happened. There's really not a whole lot of negotiating to go back and forth on that. It's worth $650, and we can argue over $10,000, $15,000, and we won't. We're not going to die on that hill.
Right.
We're going to get close enough to say, you know what, we had hoped for this. We got within 20 grand. I think this is something we should take. Let's go ahead and move on. It worked out.
And think about this: as citizens of the state of Florida, we passed this bill, right? So you should take advantage of it.
Absolutely.
And use it. It's there for your benefit. But if you don't, because you don't know about it, it's just going to be money kept in the city, the state's pocket, and they're obviously not a money-making machine for them. They know it's there, but again, they're not going to remind you to do these things.
And another thing I want to point out is you can certainly do this on your own. We get that question all the time. Well, can I just go down and appeal it? Absolutely. But I can tell you from experience that they're not all forthcoming on what your options are. And they've told us some things, not knowing that we knew the law very well, that just really weren't what we understood to be true. So we took it over and ended up winning those cases. Yeah,
and Casey, I think it goes to your point. Some people are just kind of like stuck in there.
Sure.
They've been on that job for 30 years, stuck in their way. They know what they know. And, like you said, it just may not, I don't think they're trying to mislead anybody. They're stuck in a certain way. And this is a relatively new rule. I mean, 2008 is not that long ago.
And values were going down in 2008. So it wasn't until a few years after that this actually became relevant. Right. And it kind of fell off the radar because it wasn't relevant when it was passed. And then 3 or 4 years later, I'd say it started to kind of turn around. And now it's the last 2 or 3 years from now, it's been crazy inflation, appreciation rather, in the area.
Yeah, and a little bit of history. We kind of touched on it before. I'd heard about it, then heard about it again, and something just went off. Goes, well, there's some potential there, and we started looking into it. And Casey's done most of the heavy lifting on the research and whatnot, but we've spoken to judges, attorneys, people at the county, quite a bit of experts to say, what is this? And of course, just like anything else, said, well, let's just do one. Yeah. We went to a friend, so when you're selling, and we saved her $3,800 a year every year. And this is a realtor who had been in the business for 25 years that didn't know what we were talking about. And we went and did it. And in this case, she told us on a Tuesday, we had it finished by Thursday, and she closed on Friday. That doesn't happen all the time.
Right. That's
which is okay.
The informal appeal went well. It was an obvious case. There's a lot of nuance in what we're talking about, and we've only scratched the surface, But what we try to, tell people is you don't have to know all the answers. Just a couple questions, and we'll answer everything you need. So with all the nuances and changes, if you go up in value and down in value and things like that, we can handle all that. All you need to do is recognize there's a difference between what the market value is on the tax rolls versus what we know the market value to be or assume it to be based on that new listing price that's been given to you.
Right. And if you don't know where your tax card is, you could literally Google your county property tax assessor, and you're going to see that. You'll get a direct link to put in your name or your address. It'll pop right up. It's public information, right? So do that first, and then you're going to look for the market value and the assessed value. And now we're looking at the different numbers you keep talking about. And that's where you're going to find your answers.
Absolutely. And we get the question, well, shouldn't I do this now? Well, not really, unless you're looking to sell in this year.
Good point.
There's no reason to raise your market value if you're going to be there 4 or 5 years because there's no shelf life. There's a shelf life on that. Next year, we'd have to do it again. So unless you're getting ready to sell,
another good point.
Don't worry about it.
Yeah.
And what I do want to also point out is the trim notice, which is kind of your official notice from the property appraiser's office of your proposed values, gets mailed out in August. Sometimes a little different from each county. But when that's mailed out, there's a date on it. And it's typically 25 days from the mailing. And that date is the absolute last day you have to start an appeal. So if, it's usually the first week of September. So if you come to me in October and you say, hey, my values look way off. If you're selling in 2024, I cannot help you. Nobody can, because if you have not initiated that appeal, which is what we take care of.
Right, the standing.
Well, it's the standing, and they have to put a closing date on when they accept appeals. So they formally notify everybody in the county in August, and then they give you 25 days from that formal notification to argue with you.
Damn sneaky.
And if you don't do it, it's too late. And, there's been times where people have filed for Homestead, and they get their trim notice, and it's not on there. Well, they caught it. They came to us, we went and added it, and they were fine. But if they hadn't noticed that there was that missing piece on there and the date came and went, they'd have to just do it next year. And they'd lose out on that year's worth of appreciation and that year's worth of $50,000 exemption.
So another thing you need to keep in mind, when you get that trim notice, you got heads up. If you're looking to sell, then that's going to be your drop date at 25 days from that notice, and the date will be on there.
Correct. You're under a time crunch once that comes out. Let's just say by the end of
August, you might want to get to moving and get that taken care of.
If you know you're going to sell in that calendar year, let's take care of it. Yeah. Even if it's in January, say, this summer we're going to probably sell because we're going to move down to wherever. Yeah. Let's take care of it then. That gives us a lot of time, and with time comes flexibility and some more options. So.
Yeah, and I think when you guys go to their website and check them out, you're going to see how reasonable this is. Like this, I was telling my producer Charlie about this. And he literally thought something like this was going to cost thousands of dollars, and he was like, "I'm debating like I would even do it then, right?" Yeah. And then when I told him what you guys charge, he was like, "That's a one-time fee?" I was like, "Yeah, plus a filing fee." And he was like, "That's unbelievable." So, I mean, I'm not gonna get into that here on the show, but check it out. It's worth it. I definitely endorse this product and these two gentlemen because it's a hard job. Like I couldn't do this. Like when people are like, "Oh, I could do it myself," you can't do it yourself. And plus, unless you're a licensed appraiser, they're not going to listen a lot to what you have to say.
You remember, we're costing them revenue to some degree, and when you go in there to appeal this, you're costing them some revenue. It's savings to you, but it's a cost to them. So. They're not always super efficient and super, accurate in what they tell you.
I bet a room full of attorneys, you guys probably are showstoppers when you walk in, especially if those attorneys might be divorce attorneys here.
Absolutely.
How does this work? As we're sitting here, we're talking, like, how does something like that work? Because, a divorce sometimes, doesn't end, it's always pleasantries, right?
Sure.
It's not what's yours is mine and mine is yours type deal thing. So when you have a divorce situation, what do divorce attorneys think about portability? Because I imagine there's got to be someone gets, to claim that.
So,
and I'll speak first, then turn it over to him. But we kind of backed into the divorce side because it came up a couple times, and then we saw, well, these people, meaning the attorneys that deal with just divorce, don't know how to handle this and how to calculate it because it's a tangible asset. So we did a lot of research and figured it out. And I'm going to turn it over to Casey because he knows a little bit more about it than I do. So.
Right. So he used a word that we want to emphasize, and that's asset. Portability is a marital asset when you're both on the homestead. So if you were to sell a home that was a marital property and there's portability on it, and then you get divorced, by default, that portability benefit is split 50-50 between both parties. That doesn't have to be how it happens. And there's a ton of different scenarios that may play out in a divorce. And it's important to recognize how each of those would work and what the value would be. So not every divorce requires the home to be sold. So if a husband and wife are divorcing and the husband's keeping the house and the wife is getting bought out of the house, there's a good chance she's going to leave that with no portability. So if that house has a $500,000 portability benefit, which is the max you can take with you, and they don't do anything specific to that, she's going to be starting over on her new home. Another example would be, let's say you do sell the home and it's split 50-50, but the wife wants to move to Georgia. Well, she's getting half of that benefit and it's going to go away. And you don't have to split it 50-50. You can designate shares to either party. So in the wife's case, she might want to hold that, approximately $5,000 a year tax savings for the rest of his life as a trading, something to barter with. And maybe she keeps the cat, he gets the portability, and the attorneys can hash that out. That's not my, specialty, but there's a lot that goes into it. And I've had, unfortunately, way more calls of people calling me saying, why don't I have portability? And I have to explain to them because it wasn't addressed during the dissolution of marriage. And you could have, but the best attorneys out there don't recognize this. And it was explained to me that, for attorneys, they're not specialty, they don't specialize in property taxes. Sure. And it's really not their jurisdiction, but the asset is there, and knowing your options with it are extremely valuable. So, with portability, the most you can ever transfer is $500,000. And if there's two parties, it's split 50-50. But the Save Our Homes cap, which is that 3% cap, theoretically, the difference between your assessed value and your market value could be indefinite. So if you have a spouse that wants her half of the portability, all she can get is $250,000. But let's say there's $1 million spread on there. In order for her to get her half, the $1 million spread gets reset and there's no portability. And then he would only have $250,000. So he'd be out a lot of money. So it's in his best interest to give her something in exchange for not touching
the remaining portion. Yeah.
And, it can get quite significant once you get into these larger dollar amounts.
And a lot of it has to do with, you explain a little more, the abandoning the homesteads and the timing on that.
Correct.
Because like you say, you're getting divorced, but you're not necessarily selling the property, or you are selling the property, somebody's moving out of state. So there's a lot of nuance in there. And what we do is look at, whichever side hires us and say, here's what we recommend to protect yourself, or here's what options may be available that both attorneys don't know yet.
Yeah, and you said something, Casey, that's kind of really jumped off of me here, is it's an asset.
Absolutely.
Like, I would have never thought of portability as an asset.
Sure.
And so you said it can be passed down, it can be transferred. Same thing. Can that be done in like an inheritance format? Can you do that? Or
it cannot.
You cannot.
No, you have to be
alive.
You have to be on the homestead. Okay. Yeah.
All right. I was just wondering when I heard that.
Now, the difference is if it's a married couple and one of the spouses passes away, then all of it goes to the surviving spouse. So there's no transfer of ownership issue there. It just all falls under the person who is on the homestead.
Yeah. No, that makes complete sense. So, yeah, I imagine you probably get some sticky phone calls from those situations about where's my portability.
Yeah.
Well, we've gotten calls in the middle of cases where somebody steps out of the courtroom and calls and says, hey, this is what they're telling me. What does this mean? And how do I defend against it?
Oh, wow.
I think he's gotten calls at the fire station.
I have. I may get a call while I'm on the phone that I got to hang up, but here's your answer.
Yeah,
we work it out.
Do not do this, or absolutely do this, or yes, you're going to get some portability benefits, but it's going to reset your taxes, which have been protected by the homestead. Do not let that happen. So we break it down and tell you exactly what it means. And we're actually, with wealth managers, breaking it down to a net present value. So based on this stream of incomes you're going to have, and based on how long we think you're going to do with a reasonable cap rate, we'll give you a present value of today of what your portability benefits in generally are worth. So that way, now we have a number on that tangible asset that we can negotiate for or against.
Yeah, this is huge. This is phenomenal stuff. And again, guys, take advantage of what you guys are offering here. If you're listening, go to their website, My Exemption Check. Go talk to Steve. Go meet with Casey. If you're looking to buy, go file Homestead. If you're looking to sell, call these guys right after you hang up with your real estate agent. It's just that important. I mean, all I've heard is money savings topics, conversations, tips, tricks. This is all public information. You can learn how to do it.
Right.
You're probably not going to get it done. There's going to be roadblocks we just heard about in the way, and you need their expertise in order to make this happen here. And I just can't thank you both enough for coming on the show and lending that expertise to our audience today.
Absolutely. We appreciate you having us.
Yeah, absolutely.
Appreciate the opportunity.
Man, it's been awesome. Guys, if you like what you're hearing, please share this podcast. Please send it to a family member, friend, colleague, 5-star review it on our platform. More importantly, leave us comments. Good, bad, and different. Reread them. We like them. We answer them. And it makes us do a little bit more on the show here as we dive into different topics. So again, gentlemen, thanks for being on the show today.
Yes, sir.
It was a pleasure having you on here.
Thank you,
Yeah,
Quinton.
appreciate it.
We'll see you guys in the next episode of What's Your One More.
I got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so